CEO of Kenya's Nairobi Securities Exchange discusses prospects for Kenyan market in 2020. And Brazil's Petrobras closes $1.5 billion deal to sell stake in African joint venture. And natural gas pumping from Israel to Egypt to start today. Thank you for joining us and welcome to Business Incorporated. I'm Chimeze Obi Iwagu. We get the show started now with the markets. Well, the negative sentiment seen at the Nigerian stock market on Tuesday continued today, as at midday, the all-share index was still in the red zone, down 0.91%. But in South Africa, the index went northwards. The JSE index was up 0.16%. In Egypt, the EGX 30 was also in the green, trading up at 0.12%. The Nairobi Stock Exchange closed Tuesday's session down. In the Middle East, mixed sentiment was observed at intraday, while the markets in the UAE were looking up. Other Gulf markets were down. Abu Dhabi and Dubai Financial Market were up 0.11% and 0.54% each. Qatar was down marginally, while Saudi Arabia came down by 0.15%. In Europe, stocks inched lower this morning as investors await the signing of the Phase 1 trade deal between the U.S. and China, with optimism slightly dented by comments from the U.S. Treasury. Let's see how these and more are playing out in the European space. Today, well, let's bring in Orich for those details. Hello, Orich. Good afternoon. The big day has finally arrived. The Americans and the Chinese are due to sign the first part of a trade agreement today in Washington. How relieved are people in the market, or are they irritated at reports U.S. tariffs on billions of dollars worth of Chinese imports are going to be maintained until after the completion of a Phase 2 deal?
Yeah, I detect little relief. People say, well, the day is finally here. No surprises expected anymore. And that Phase 1 deal and the long wait until a Phase 2 deal is reached is basically priced into the market at the moment. And irritation, yes, I detect that because there are perceived remarks by Steven Mnuchin, the Treasury Secretary, who said that there wouldn't be any cutting back of tariffs until a Phase 2 deal was signed, and unless also the Chinese fulfill the obligations from the Phase 1 deal. And there are quite a few obligations connected with that. So that gave pause for thought. That has been occupying the market since then. Robert Lighthizer and Steven Mnuchin did issue a statement, though, today, that it was not any written or oral commitment in terms of the tariffs at the moment. So perhaps trying to calm the perceptions a little bit, but the markets are still very much irritated. And they're flat here in Europe, waiting for that deal to be signed.
Right. Well, part of the process seen in the process towards today's signing, an important step towards the next stage, is that U.S. President Donald Trump is no longer accusing the Chinese of manipulating their currency, but currency manipulation is now apparently an issue with the Swiss. Tell us more.
Yes, Trump calling the Swiss currency manipulators as well. And now the Swiss franc has soared. It's gone to its highest in 33 months to €1.0763 because markets think that the central bank in Switzerland, the SNB, will be trying to address those U.S. concerns on currency manipulation and reduce their intervention in favor of the dollar and against their own currency in order to reach that goal. The Swiss, of course, have intervened against the Swiss franc very heavily because it's been under an enormous appreciation pressure. The Swiss economy is going well. It's a safe haven. And of course, if the Swiss franc is too high, too hard, then it makes exports, has made exports for the Swiss very difficult indeed, and has basically priced the market, the tourism market, the Swiss franc has priced the tourism market in Switzerland out of the market. Tourists basically can't afford to go there, very few at least. And the Swiss, if they are living on the border to Austria, Germany or France, they get a lot of their shopping and a lot of their gasoline done on foreign soil, and that hurts the Swiss economy as well.
All right, let's look at the data out today. Germany released its GDP data for 2019, posting worst annual growth since 2013. How deep was the impact of the slowing world economy on Germany? What are the prospects of 2020, and how are the markets reacting to it?
Yeah, the impact of trade and Brexit were deep indeed. They weren't the only factors, though. Economists point to the fact that there could have been more public spending in infrastructure, for example, in construction, but other economists point to the fact that that was almost not possible because of the capacity being reached in construction, for example, and in some other businesses as well, in some industries where paradoxically the economy is suffering, but there are not enough qualified workers to take care of all the contracts, all the offers that are there from customers to get service. So it's a complex situation, and it's led to the fact that 2019 the growth slowed to just 0.6%. In 2018, it was 1.5%. In 2017, 2.5%, a worrisome trade. And Germany will have to do more. And I think in the meantime, most economists are calling out for more public spending. There was a government budget surplus of 1.5% in 2019. So if you can get that capacity question addressed, there's more than enough money to do something for the infrastructure, for jobs, and for the economy.
Thank you, Orich. Let's keep an eye on what happens in Washington today. Thank you and enjoy the rest of the day.